Welcome to the Wealthies Circle podcast, where we take a deeper dive into this year's finalists and winners from our wealthmanagement.com 2020 Industry Awards. These interviews cover the challenges, innovations, and trends in the wealth management industry and the individuals working to help advisors better help their clients.
Thanks, everyone, for joining us. I'm David Armstrong. I'm the editor-in-chief of wealthmanagement.com, and this is the Wealthies podcast. Today, this is where we speak to winners of the Wealthies Awards, our industry awards for financial advisors and the people who sell into the financial advisory community. Today, we're speaking to James McDonald, CEO and Chief Investment Officer of Hercules Investments. James won for the Asset Manager Alternatives category, Hercules Investments, Systematic Volatility Trading Strategies. James, thanks a lot for being with us.
It's a pleasure. Thank you so much.
So the way that we've been starting these things out, James, is by just let me asking you, tell our audience, financial advisors, what you do for advisors, what problem you solve for financial advisors.
There's a challenge for every money manager, financial advisor, financial planner, portfolio manager. There's a challenge, and that is keeping clients comfortable with what's happening with their portfolios in the market. And there's been so much risk in this market that has not translated into changes in equity prices for the negative. There's a lot of confusion. And what we do is we capitalize on systematic volatility. And what systematic volatility is, it's the repetition of risk. And there are crowds, and then there are angry crowds, and then there are happy crowds, and then there are fearful crowds. In any case, when emotions hit a crowd, they're more predictable. And we've seen this in stampedes for toilet paper. We've seen this in stampedes for music tickets. Whatever it is, people are more predictable when they're excited in a crowd. And that's how I describe volatility. Volatility as a science is often debated because there are so many different tracking instruments for it. But I like to describe it as simply the crowd rushing to something. And we're experts at profiting when that happens. And so for financial advisors and for investors who are worried about knee-jerk reactions or perhaps a change in sentiment that perhaps devastates a stock holding or investment portfolio. Yesterday, President Trump tweeted that he was not going to negotiate the stimulus bill until after the election. Just that tweet, just the comment, no legislative action, no material change, just the comment sent the market into a panic. We took a position in volatility prior to that because it was so low, and we're able to generate a profit from that outcome, not because we have a crystal ball, but because we recognize when volatility is low, when the crowd is quiet. When the crowd is quiet, it means that eventually that crowd is going to come back into action. And so through various volatility vehicles, we're able to position capital to either profit from the eventual movement of the crowd in a dramatic way, or protect portfolios by giving some volatility exposure. And we do that systematically in that there are clues in situations which always trigger fear and greed.
Yeah, for sure. And this has certainly been a season of volatility, right? I mean, I don't know, in the past, since the whole pandemic shut down, has it been feeling like shooting fish in a barrel over there? I mean, volatility has just been all over the place, is it not?
Well, it would seem that way, but in reality, volatility has ground to all-time lows in 2020. We've seen the 12-year bull market capitulate, and it capitulated in February. And at that point, just before it capitulated, volatility was at a statistically impossibly low level. So we scooped it up there. We didn't know there was going to be a pandemic, but we knew that it was a statistically impossible low. And so volatility had a huge spike. Obviously, the pandemic was a shock. And so volatility rose so high that it became impossibly high. At that point, we sold volatility by selling call and put options just before expiration, collecting that time premium. That was a great strategy. But then the Fed came in to rescue. We've never seen a Fed lower interest rates twice in as many weeks. They came to the rescue, and there was a dramatic rally in the stock market. And that dramatic rally pushed volatility again to very unsustainable lows. And we saw a very, very, very good discount on volatility around June 11th. As the market kind of peaked at that point, almost an 11-day rally, almost unheard of. we got a spike in volatility then. And then at the beginning of the month in September, where we saw another a big, amazing rally. August was the highest rally month, second highest rally month in all of history. And so we saw almost an 11-day run on the NASDAQ, 8-day run on the S&P and the Dow. And so we took advantage of that as well. So we've had those 3 big spikes in volatility so far, and we expect another big one ahead of the election.
Yeah, for sure. And let me ask you this. I think a lot of advisors out there are thinking the market where it's at right now cannot sustain where it is. I mean, you talk about the Federal Reserve interest rates being so low, kind of inflating assets. It seems to be kind of running on sort of fairy dust a little bit. I think a lot of advisors have that perspective. Would you agree?
Fairy dust works, right? You read storybooks, that stuff works. You want your favorite puppy or your unicorn or your favorite car, fairy dust works. And the fairy dust that the Fed has spread along has allowed this market to run, and it may continue to support higher than average equity returns. But yes, there is an imminent repricing coming. We are looking at a price earnings ratio, whether it's cyclically adjusted, the Cape-Shiller ratio, or whether it's just straight earnings to prices. We are seeing the second highest levels in equity valuations. This is post September correction. We're seeing the second highest valuations that we've seen since just before the dot-com bubble burst. And so even if we remove the element of the pandemic, which is certainly the biggest risk to the market, we're still overvalued. And so when you put that in there, we certainly have to see some pressure coming in stocks. But then we've got the anomaly of when there's a crisis, there are unprecedented steps taken, right? And so what the Fed has done, particularly with Powell coming out and saying they're going to hold interest rates for 36 months, that's an incredibly long time for a conservative central bank to project uncertainty. That's an incredibly long time. And so there's going to be some complacency and some comfort from the big institutions about, where these prices can come down to. I do think we're going to retest the March lows. And at that point, I think, the discounts will be there for some of the good names and we'll get some buying coming back in. But, fairy dust works. And when it's Fed fairy dust, we've been educated that it can absolutely support a market.
Yeah, for sure. And you talk about the valuations, some of the metrics, price to book, price to earnings, whatever it is you're using, being at all-time highs or near all-time highs. I seem to remember before the pandemic hit, people were also saying that, and that it was only the U.S. consumer that was keeping the market going. This is pre-pandemic, right? And it seems like the legs have been cut out underneath the U.S. consumer, minus the federal stimulus or federal aid that's been given out. So I think that just makes another stool or another leg on the stool of worry about this market, right? I mean, if there is no more consumer relief, or even if there is, it doesn't quite add up to what it should be. I think we're going to see more unemployment coming forward. That consumer story is going to peter out eventually, right? It's got to. So yeah. I mean, where does the market go then?
Absolutely. And so, it's a good analogy to use a leg on the stool. And so consumers have had a rough time of it. We're looking at employment pinches in the retail sector, obviously, in the transportation sector, obviously, in the gaming and hospitality sector, obviously. As we keep ticking off these industries, which are most susceptible to pain from pandemic, as we keep ticking down these industries, we start to see, an aggregate level of income impact that will go beyond the PPP program. It'll go beyond what the Fed can do. And that is going to have a disastrous effect on small businesses and a disastrous effect on the economy, which is why the Fed did what it did. Those are the smartest people, economically speaking, in the world. And thank God they're independent and objective, right? They're not trying to sell products or earn fees. They saw what was coming. They took those emergency measures. But we're a big economy, and it's not going to be enough for the long term. And yes, the consumer is going to feel pressure that's going to matriculate to the stock market. The pressure that we're looking at, that we're paying close attention to outside of anecdotal observations, we're looking at what banks are receiving in terms of their loans. We're looking at defaults. We're looking at mortgage payment timing. We're looking at credit card payment timing. We're looking at how they're paying their bills, because ultimately that will be the arbiter for what happens with banks in the financial system.
Yeah, for sure. Let's talk a little bit about how financial advisors can work with you. What do you do for financial advisors? Are you, how do they approach you? What's your relationship with financial advisors?
So what we like to do is we like to position them to protect their clients and to increase their clients' growth prospects. And so we're a growth-focused advisor. What we do better than anybody else in the world is we put the right amount of exposure to volatility in a portfolio. We're able to calculate that. We have a lot of RIAs come to us and say, look, we've got a client who's got, X number of millions of dollars in Apple with a concentrated position, low cost basis. They don't want to sell, but they know the pain is coming. So we can take 10 to 18% of the value of that portfolio and hedge that risk in that Apple concentrated position using volatility and offset losses in Apple. And if we do a good job, generate gains there. So we do a lot of risk hedging for advisors who've got clients. And then we do an overlay. And so we put our systematic vol strategies over a portfolio strategy. So when the market comes down precipitously, there's an offset and rise in gains on that volatility. And what we do really, really well. We've traded over $5 billion in index options over the last 6 months. And so it's our real specialization where we're able to position capital that moves upward when the market moves downward dramatically.
Okay. So, but advisors will come to you with specific accounts or specific portfolios that want to, for lack of a better word, protect. You'll give them some overlay strategies in the volatility market to give them that protection.
Yes.
Okay. Great. And tell me a little bit about where you came from and where Hercules came from. How long have you guys been around? Did you come up in the RIA space, come up in the hedge fund space? Give us a little bit of your background.
I have the weirdest story. I'm a football player, and from the time I was 12 years old, I wanted to be a football player. But like many, I blew my knee out my freshman year in college and shifted to a financial career. I came up as an investment advisor, then a wealth manager, and then I was director of strategy for Compass BBVA, where we had about $12.5 billion, mostly in trust accounts, where we had to deliver insurance, brokerage, and asset management in an integrated way. And in that environment, I started building the systems to protect trust accounts from big market pullbacks using some of the Treasury groups' algorithms. And so that was my specialization. I came out of that environment, built an RIA, got my knee fixed, have been playing semi-pro football for the past 12 years. And that's what my heart desires, is to play football. And when my football career ended last fall, I had 12 years in, and I set my next goal, which was to buy an NFL team. And in the hedge fund space and in the index option space, certainly a realistic objective. And so we built Hercules. We started Hercules last fall to generate performance for individual investors and generate performance for intermediary advisors that would accrue to compensate us well enough to get us an NFL football team. And so that is our mission. We've got to generate about $12 billion in profits for our clients utilizing these strategies, and we're well ahead of plan.
Wow, so that you've set a great intention there, right? You have an intentional strategy to get to a specific place. That's fantastic. It's a great goal. Let me say this. When advisors, it seems to me when you talk to RIAs and talk to advisors these days, so many of them are, the mantra that they hear and the mantra that they are encouraged to repeat to their clients is wait out the volatility. I know there's going to be bumps in the road. It's going to go down. It's going to go up. But you know what? We're focused on the long term. We're focused on the big long-term goal. So don't be paying attention to the markets every day. Pay attention to the goal, and we'll get there together. It sounds like you don't disagree with that message, that's what we should be talking to the clients about. But advisors might need to take a little bit more of an active hand in the portfolios, correct?
Yeah, and it depends on your goals, right? And so if you walk for 2 minutes a day and eat 2,000 calories a day and be average, you'll probably be okay. And, on average, if you can hold your capital and not need it for 10-year periods, you're going to do okay. You're going to do average. And so, some people want to join the triathlon. Some people want to be great athletes and want to be fit and want to be in the top 1%, top 10%, top 15% of human beings. And those who strive for more Those who are growth seeking, those who want elite performance need a different strategy. And so buy and hold works in 10-year increments. And they're right. If you weather the storm, you will end up on average as well as you would have been if you had tried to navigate with an average mindset. But we're elite at what we do. And our 2 and 20 performance fee lays out our case. We don't perform, we don't get paid. And so what we're doing here is we are taking an exceptionally focused approach to identifying support and resistance levels on the indexes and then translating those into trades. And so we're not for everybody, but for a client that's got aggressive growth goals, and they're looking at the performance that they did not get in this last bull market over the past 12 years where, you've had names like Amazon and Netflix and Google and Facebook, you've had them run tremendously where they were over diversified or they were in one of these portfolios that had kind of the 10-year average. They missed out on returns. And so they want to catch up. And so people who hire us are looking for A, growth, and B, elite performance. And that's what we do. And that's how we select our clients. We're not for everybody. If someone has a conservative fixed income approach strategy, we're not for them. But for people who want elite performance, who want profits and who want growth in a risk-controlled way, those are the folks that align well with us.
Yeah. And what I was also expecting you to say there was something about people have that mindset of, 10 years, don't worry about it, let it go, as long as the market's doing fine, right? As long as there's no major pullback or major correction.
You got to get right. It's like the old real estate game. Everybody has a rich uncle that does real estate in this industry. And they always say, buy real estate. It totally works if you initiate at the right point in the cycle. Right. And so right here where we're at the end of the longest bull market in history. And so in all probability, we don't have a crystal ball, but in all probability, markets will be under pressure in the near and the medium term. And so if you are not all set, quote unquote, right now, you've got to take a systematic approach to identifying ways to grow your capital without just plunking it into the market and hoping and waiting for a recovery, because we may see a market that's lower a year from now from where it is. We may see a market that's lower 2 years from now where it is, and 3 years, and so on and so forth. And we simply don't know. And so what we do is really, really target it for people who want growth and who want active management. But it takes skill. You can put a baseball bat in 100 baseball players' hands, but maybe 1 or 2 of those guys can hit 300 or better, right? You can put a football in every quarterback's hands, but maybe only 1 or 2 of those guys will have a touchdown to interception ratio that's favorable. And so everybody isn't great. Most people are average, and what we do, we're the best in the world at.
Well, it strikes me because you're hyper-focused on it, right? You're not distracted with trying to do everything for everybody.
Absolutely.
A lot of asset managers have put some retail products out there, some liquid alternatives, hedge fund strategies in a mutual fund wrapper or ETF wrapper, or some of the smart beta funds that are out there, which, on paper anyway, ostensibly say that they're going to do the same thing you're promising to do, probably for a lot cheaper, right? How would you respond to that?
I would respond with, we have a red herring with the SEC approval pending, and so we'll have a ticker here soon with our strategy.
Okay. So you are going to roll out a retail?
Yes.
Okay, fantastic. But again, the idea is that you're taking an active approach to these markets, whereas I think a lot of like the smart beta folks are kind of, trying to make it all rules based and taking the human element out of it.
Right.
You still see room for the human element in the trading.
Fairly. So the human element is, the behavioral finance is where we kind of trade. We're looking for the crowd, and it gets difficult to explain. But in behavioral finance, they're basically assumptions that people as a group will repeat past behaviors, right? And so if that's true, we can take advantage of volatility, and we can take advantage of shifts between fear and greed systematically. That's why it's called systematic volatility. It's not guessing. It is rules-based. We do.
So you do have this in a rules-based.
We use formulae. We have dozens of libraries of algorithms where we get probability distributions and use calculus to determine what the win-loss rate will be, and then execution is in the key. And an algorithm doesn't know what Twitter is, right? Algorithm doesn't know what a bankruptcy notification is or a plane flying into a building. So we do have subjective authority over the execution. It's not a black box strategy, but we wait for situations to occur that imply there will be a recurrence of human behavior from shifting from fear to greed. And we've been extremely, extremely successful at it. It's even better when markets are under duress. People are more predictable when they're afraid. And so this market is really setting up for us to have a record month again, as we did last month.
Yeah, for sure. When you're out there talking to advisors and you're talking about your strategies, are you noticing a greater interest in this kind of thing just because of where we are in the markets? I mean, has the phone's been ringing off the hook? Have the inbound marketing things been working?
You
I mean,
know,
it seems to me that this is.
we do is almost unbelievable. It's almost not believable. And we're earning 30 cents on the dollar of assets we manage, right? And a typical advisor may earn 1 or 2 cents. And how is that possible? It's systematic vol, it's 2 and 20. And so when we talk to an advisor, we have to first understand what their economic goals are. And of course, it always has to be suitable for the client. But in the reality, when you're trading options contracts and you're correct and you're accurate, and there are big moves in these indexes that are not predictable, but consistent in their behavior. So loss management and loss minimization is very, very efficacious. We're taking a lot of advisors and really, really, really growing their income. And we 5X and 10X advisors' income. And we have to prove that we can do that because it's almost not believable. But the math works when you execute these trades right. And so when we talk to advisors, A, their clients have to be growth focused. B, it has to be suitable. We're talking about index options, probably one of the most dangerous securities out there and options. And so it has to be suitable for the client in that way. But then once we make those alignments, we are growing accounts in a market that's declining. And to your question, there's absolutely more interest now because in the previous 6 months, people are just opening their statements and the account's higher than it was the month before. People are comfortable when their accounts are growing. And it doesn't mean their accounts need to grow a lot, but as long as they're positive. But now the market has stopped going up, at least as of last month. Heck yeah. If someone is saying my portfolio of clients, their balances are going to go down. Apple is not going to keep hitting new highs every single day. And my fees are going to go down. My income's going to go down. And if there is a black swan or if there's a tail event or if there's some type of furthering of risk, this market could come off dramatically like it did in March. All the gains since then would be wiped out. And then there's more downside below. And so there's certainly more interest now that the market has stopped going up and that we've established ourselves as being credible. To be taken seriously in this industry, you have to produce results. And so we do have GIPS compliance performance numbers that are eye-popping, and that helps a lot from where we started. And, we're very fortunate and blessed and lucky to be recognized by wealthmanagement.com as well. There's a lot of people who compete but don't get an opportunity to perform and to perform well. And we've been able to do that. And, the media is picking it up as well. In the past 7 days, we've been highlighted by CNBC and Wall Street Journal and Fortune and Forbes and Kiplinger and Barron's and Bloomberg, and that's not an accident. It's because what we're doing is really working. And we're excited about it. And we're excited about our partnership with wealthmanagement.com.
Yeah, well, it's great. It's wealthmanagement.com. It's we have a team of independent judges that vet all of these entries, and they were excited about your entry and enough to give it the winner in the alternative space. And it was a crowded field. There's a number of asset managers compete in that space. So congratulations again to you and your team there, James.
Thank you. We're really excited about it.
And thank you, everyone. I think, James, unless you have any last comments.
I would like to say one thing that doesn't get talked about a lot in our market is, in past crises, they've been triggered by global events and, no pun intended, but, the contagion of weak markets happens. And we haven't talked a lot about the weakness of the central banks around the world compared to ours. We know our Fed can come in and do whatever it needs to do, but other big developed economies like South Africa and Brazil and Russia, they're looking at very, 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 very precarious fiscal budgets. And so we're keeping an eye on that. We want advisors to be aware of things might be okay here, but if they are declining and deteriorating abroad, that'll eventually come get us. So let's just keep our eye on the international picture as well.
That's great advice. Great advice. It's true. And the precariousness of the index investor as well. I mean, this is something else I did want to ask you about. You mentioned the FANGs as being the big drivers of most returns over the past couple of years. I think most advisors, and certainly most clients, I think probably maybe many advisors, don't realize how large of a component those stocks play if they're just taking a pure index approach to the markets. Correct?
Yeah, we're over 23% last time I checked. The S&P's constituents was in tech, and in our industries of advisors, we've seen more diversified indexes. Big oil and Berkshire and General Electric and industrial companies would smooth out those indexes. Now it's tech, and healthcare, right? And so we definitely want to be sensitive. We're really excited about a product that's coming out from NASDAQ called VolQ, VOLQ. And it is a volatility product for the NASDAQ 100, which gives us a more laser precision to target protection and or growth from tech. And that, obviously, that index, the NASDAQ 100, it's going to have more focused, efficacious impact on a portfolio because all the things are in there. And then all the big healthcare companies, the pharmaceutical companies that are trying to find cures for this virus are in there as well, all of them. And so we're really excited about that product, VolQ, as a tool to help advisors protect these portfolios that, maybe the portfolio isn't all tech, but maybe most of the gains are tech, right? And so we're really looking forward to using VolQ to lock those gains in.
So diversity maybe is not, many clients aren't as diverse as they think they might be in their investments.
And it's one of those things you really have to do a close look, and there's over diversification, there's under diversification, and performance attribution. And even if you do diversify, the whole point of diversifying is de-risking and then giving yourself an opportunity to catch a winner you may not find. When that winner happens, that winner represents most of the attribution of performance in the portfolio. And so you still have to protect that thing that drove returns. It's very unusual to see an evenness of returns across sectors. Most sectors have stayed negative since the pandemic hit in February. We saw the energy space absolutely destroyed through this pandemic. And, diversification is important, but also active management as well, because things change.
Yeah, for sure. Well, James, thanks very much. It's been enlightening for me. Congratulations again on the win. And I'm sure we will be hearing from you again in the near future.
It's been a pleasure. Thank you so much.
Thank you, everyone. You've been listening to the Wealthies Podcast with David Armstrong, editor-in-chief of wealthmanagement.com. See you next time.
This content has been made for information and educational purposes only. The views and opinions represent the views and opinions of the guest and does not necessarily represent the views and opinions of wealthmanagement.com.